So I'll start with the market update. So as a lot of people probably know, we've been dropping a bit, and the market has sold off. I think the main reason that we're looking at it is because there's, which represents part of the election, there's a failure to agree on the stimulus package. So I think the latest was roughly the Democrats wanted 3 trillion, the Republicans wanted 1 trillion, and they're sort of they're, as they say in the Brits say, they're faffing around on what's going to happen. So now increasingly no one thinks anything is going to happen before the election. So that probably explains. And this is what this graph shows, is the probability of essentially a stimulus package passing at what date. And more people are starting to believe that stimulus package is probably going to pass after the election, so around January, not before January 2021, which explains a lot of the sell-off. Now, the big question is how far do we sell off before the Fed starts thinking that we need to do something about it? So I think someone asked me the question previously, but I think we're going to get some uncertainty, of course, before the election date. And then after that, it'll probably be relieved to a certain extent because people will know what the status is. The question is if we sell off too far in this current correction, when does the Fed step in? I'm just going to come back on the FOMC because that was a fairly important statement that we had since our last sort of discussion. So this is a quote from Powell, the chairman. Until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. They're not moving interest rates until then. So that basically says they're going to stay low for a very long time. He also said inflation projection for 2023 is 2% with 4% unemployment. And Powell thinks actually unemployment is understated by 3%, he said in his speech during the comments and questions. So that means, because if you remember the dual mandate of the Fed, which is price stability, so inflation targeting and full employment, he thinks that we're far away from full employment. So that seems to not even be a criteria right now. The only thing they're really looking at is they become an inflation targeting Fed, and almost exclusively. So if you look at their dot plot that they issued, they think that the Fed funds rate's not going up at least until 2023. And if you remember that Goldman note I showed the other day, they assume that nothing would happen until 2025. So just reiterating, lower for a longer time. Another graph that sort of shows this. So you see on the x-axis, you've got employment divided by the population, so sort of the participation rate plus inflation. And it shows basically these data points. I haven't checked this to see if the data is kosher or not, but the data points basically show what the Fed funds rate is versus that employment ratio plus inflation. And so August, what you would be here, and you can see that even sort of external measures, not necessarily completely inflation targeting, would say that you probably don't see an increase until quite a while. And even if you do see an increase, it'll be very gradual and very low. Another interesting piece is, and you can review this when I post the slides online. I'll just briefly talk about it. It's basically saying that there's a lot of measures that have been used previously, but there's also a lot of measures that are still open. So there's yield curve control, doesn't seem to be that widespread if you look here. Forward guidance seems to have been used quite a lot. And the purchase of asset-backed securities hasn't been used that much. So there's still some policies that the Fed can use. So it's not, I don't see it as out of ammunition. And it also seems like the other takeaway is that all central banks are in sort of the unconventional mode of trying to figure out how to stimulate the economy and provide a lot of fiscal stimulus. Q2 2020 IRS earnings. So if you remember, I used the CPA tax, which is a measure that of the earnings as reported by the IRS. That year-on-year change is minus 20% roughly now for Q2. It takes a little bit longer to publish than the standard earnings. And if you look at it on a graph, I should have put this in the main section. If you look at it on a graph, this is what it looks like. And just to reiterate that equities and earning prices don't always match. So even if we're down 20%, you don't necessarily want to use that as your barometer to think equity prices are going to go up or down. So I'll move on to sort of the market segment, sort of more of the graphs. So today, I think we were up about 1%. I think this is from last night. So this is the S&P 500. these are sort of the two key levels. If you see here, this level here, which is this is the SPY. So what people consider cash on the S&P 500. So it's the ETF of the S&P 500. So this corresponds to 33,234 on the S&P 500 roughly. And then, so that would be the first level, and that's about a 10% drop roughly. And then the second level, which corresponds roughly to 15% drop, is around the 3,000 level. So this is probably the zone where you'd see you'd see it stop more or less, and because 10 to 15% really seems like it's the standard correction that you have if you don't enter a bear market, which is logical because bear markets decline by 20%. But I would imagine that's probably the area where we're going to get we're going to settle, and we might make a bounce. If it gets below 15%, I wouldn't be too surprised for the Fed to start. So if it sort of breaches this 3,000 level, for the Fed to come and take some sort of action, that would be my guess. But of course, this is all very highly speculative and a complete conjecture. Oh, and the other point I put here just as a reference is sometimes what you look at is you look at the amount that it went down before bouncing, and you usually say that it'll go down that same amount after the second one, and that would represent 3150 as a level. So those are just sort of reference points on a market basis. Moving on to the 10-year, the interesting part of this correction that which sort of shows that equities and bonds are no longer really working together, is that even though the S&P started trailing down, the yields have not moved. So the bonds are no longer a very good hedge to your equity position. So that's not very reassuring. And we basically stayed around the 60 to 70 basis point range, and we haven't really had any reaction to it. So the other one we talked about was gold, and gold basically having corrected. So if I use technical analysis on this, that's where you see that 1756 level. So that's basically saying this is sort of a triangle formation. That's the breakout point, which it sort of looks like. And if I use this, which is the base of that triangle formation, and replicate it below the breakout point, that would be a level that's sort of 1756, and that's roughly sort of this congestion zone that we had before. So it's believable that we could get down there. I think long-term gold is still on the uptrend, but there definitely seems to be a correction here. And technical analysis would tell us around that. We also know what we were talking about earlier from fundamentals is that gold got a little bit ahead of real yield, so this sort of makes sense. I think the main driver of that is probably due to the appreciation in the dollar. So the dollar has reversed. So this is the euro dollar, which is the main driver of the dollar index, or DXY. And what you see is that we had a topping out and then sort of a break lower of the dollar. So the euro versus the dollar. So the euro started going down and the dollar started appreciating. And that makes sense because if there's no fiscal stimulus, there's less risk of inflation. There's less money that's being put into the system. And so it's logical that that flow makes the dollar probably a little bit more attractive. And in that sense, if you'd see Fed stimulus or some sort of fiscal package, you'd probably see a reversal of all those things. I'll pause there because that's sort of one thing. And any questions, comments?
I have two. The first one is the retracement that you were anticipating for, was it gold or the net or the S&P? I can't remember, but are you using Fibonacci retracements for those?
This is just because that's the way trading view works. All I'm doing is basically taking this distance here. Can you guys see my mouse, by the way?
Yeah.
Yes.
Okay. I'm using this distance here, and then just replicating that distance below that breakout line here at 1919. That's all I'm doing. Nothing more, nothing fancier. And again, this is technical analysis, so all it is risk management. It's definitely not good at predicting markets.
Okay.
But that would sort of be an expectation. And then what gives you a little bit more comfort that would be a stopping point is especially this congestion here that you have. You've got quite a lot of trading here, and that congestion generally creates buyers and sellers. So that's why that 1756 sort of makes logical sense.
And then the second question was with regard to the dollar.
Yeah.
So it's kind of odd, isn't it? But it tends to work this way. Correct me if I'm wrong, but when the market goes down and people are selling stocks, the dollar tends to go up because it's a flight to safety,
Yeah, that's true.
even though it's the American market that's going down. It's just, I've never understood that, but it's,
Because it's the reserve currency. Most transactions are in dollars. It's a little bit like gold. It's the same thought as gold. I mean, if you think of gold as a currency, it's sort of the same logic. Gold is sort of a reserve for safety, and if you think of all currencies, the biggest safety currency is the dollar.
okay, because I mean, foreigners are part of the holders of stocks and other assets, and if they're selling them, then there's assets, then they're selling dollars.
Mm-hmm.
But you're saying that there are additional entities which would buy dollars just to hold them.
Yeah, I mean, most people
makes it go up.
would view it just like gold. You would buy gold for safety. It's like that's usually what people do when they're concerned. And the same thing happened in the global financial crisis. Even though the U.S. was the epicenter, it eventually it was the one that appreciated during the downturn.
So is the converse true? When the market was steaming higher, the dollar dropped in value because it was risk on?
Well, so there's other factors at play, but if you see here, I think so. This is, if you look in March, this is the Fed, sort of the Fed, the illiquidity. The Fed steps in.
So the dollar's going up there. That's the euro we're looking at.
Yeah, and then basically, as people look at the fiscal stimulus, the package, it sort of propulses the dollar lower and the euro higher.
Okay. So the euro was going up when our market was going down, and then it was sort of choppy, while our market was still topping out.
Well, this is the uncertainty around sort of the fiscal stimulus. This is sort of driven by monetary and fiscal stimulus here, uncertainty around fiscal stimulus, and then clearly the package is not going to go through the fiscal stimulus package. Again,
okay,
and during that my interpretation.
Right, and then during that choppy period, the EU was debating about what type of or level of fiscal stimulus they were going to have, and then they sorted that out.
And and part of this is that the EU also, I think, did a $600 billion package, so had a little bit more, but they're still definitely not easing as much. Again, if you were on that call with Howard Marks, I showed a graph of the M2 money supply of the euro versus the dollar.
I remember.
And the dollar has really outpaced the euro increase in the money supply.
Okay, now what about all of these long-term treasury bonds that are going into auction now? Isn't that similar to quantitative easing because they are printing money to buy all that stuff up?
So if the Fed starts buying it, yes, that would be considered monetary stimulus. But if the Treasury itself just issuing debt is not money supply.
Right, but that auction doesn't seem to be going very well. There's a lot of supply that's coming out that is being reoffered in subsequent weeks. So the buying interest is pretty meager. And so that leaves the task to the Fed, because somebody's got to mop all that debt up. Isn't that something that could drop the dollar in value? Isn't that QE?
I wouldn't consider that QE. I would definitely say that yes, Treasury yields moving would be a concern. But so can you see the screen again or not?
Yes.
That's the US 30-year. Still not moving that much.
Isn't that because to get any kind of a yield, even though you have to take a little more risk, actually, if you own stocks that pay good dividends, you can offset what you normally might get in a treasury note or a CD.
Well, that would argue that this would sell off because people would go into equities, and therefore the bond price would fall, and therefore the yield would go up. I think the main reason behind this is that people aren't concerned about inflation. One, so the real yields have been dropping, and then first of all, the inflation's been increasing, but the growth. So if you think of nominal, I'll start it again. If you think about nominal yields on the 30-year bond, it's essentially a combination of inflation and growth. Growth has not been great, so growth has been dropping, and inflation's been going up. So essentially, the real yield's been sort of staying stable. And I showed that the other day on the 10-year, whereas inflation has gone roughly from like 50 basis points at the bottom in March, sort of around here, and now is roughly up to 1.5%. And real yields themselves have been going down in the same fashion, keeping nominal yields roughly flat. Does that make sense? And the same thing is happening on the 30-year.
Right. Well, the yield curve is not steepening
No,
as much as people would have liked, and so
that's the 10-year minus 3 months. It's basically
so,
staying flat as well.
right. So you're not, because the Fed is in there buying up this stuff. It's keeping yields low, and it's, even though we're having a correction, it's still giving people very little choice. Like the person before me just said, I'm sorry, I can't remember your name, but
Barry?
he mentioned
Barry.
Yes, like you mentioned, you know, people are interested in dividend stocks because you can get at least something, some reward for the risk you're taking, whereas you're not getting that in bonds the way that you normally would.
Yeah, so I agree with the logic that bonds are not necessarily a great place to be right now, just because you're not getting the offset from them hedging equities, and the yields are just very, very low.
Right, so that's why I'm sort of doubtful about this correction, because people are kind of being, it's sort of like a herd of cattle being herded by the farmer's dog into a tighter and tighter group, because there's, you know, bonds just don't pay anymore, and they're risky, and you don't get any payback for it. And so if you're going to take risk, you might as well be in stocks.
Yeah, agreed with that.
Mm-hmm.
So where's the herd going to go? You know, even though the prices are going lower, isn't that going to sort of keep this from becoming more than a correction? Because where else are you going to go with your money? You can't sit on cash.
But that's what I was saying. It's probably just a correction. But if the Fed would say tomorrow, we're no longer doing any quantitative easing, or we're not touching the market anymore, I'd be about 99% sure the whole thing is going to collapse.
Sure, and they would never say that.
But they would never say that, exactly. So it's basically what's driving really the market right now is sort of fiscal and monetary stimulus, a lot less the other factors.
Yeah. Okay.
Does that answer your question, Ira?
Yeah, I mean, where I'm coming from, I think a lot of investors, retail investors, are coming from, which is, you know, where else are we going to go but into these risky stocks? So, you know, okay, give me a correction, but I'm going to have to sit through it because, you know, even just holding on to cash, you know, eventually inflation is going to catch up with all that, and yeah. So
The other alternative is doing cash secured puts and covered calls as a way of generating income in your portfolio in addition to the dividends.
right.
So we'll cover that, I think, on the next section. So I'll move on, and then maybe we can come back to it towards the end if you guys want. The last thing I was going to say is that we've sort of gone through the rapid bounce in terms of the recovery. If you look at it, we're sort of up this, but then beyond that, we're probably going to have a fairly slow recovery in GDP. This is not necessarily prescient to the market, but it just shows you that there's probably the gains that we've had are going to be hard to replicate going forward in terms of that actually GDP growth. So this is basically, essentially the GDP growth from starting in Q4. I'm going to switch gears, and so there's a bunch of other stuff. There's also some reading list here if you're interested. This is the budget model by Wharton for the Biden tax plan, just to see what it looks like. And then daily traffic stuff that you can take a look at. If we've got time at the end, I'll come back to it and we can go over a few more slides. But now I'm going to switch to the risk parity discussion that we had mentioned earlier and that we had talked about. So risk parity, or I like it calling risk allocation, because risk parity assumes that you're allocating exactly the same risk to every asset class. So I would call it risk allocation or volatility targeting. And the concept behind it is if you have a 60-40 portfolio, most of your risk is in equities, right? So if you've got 60% equities in your portfolio, 40% bonds, you have essentially all of your risk in the equities, because the volatility of equities is call it 10 to 15%, while the volatility of bonds is 4%. So you've got 60%. You've got 3 times more volatility in equities, and you've got 60% of that in your portfolio. So it's sort of like you have 90% of your risk in equities and 10% of your risk in bonds. And so the concept behind that is trying to rebalance the risk between equities and bonds, not the dollar amounts, but the risk. And the risk, at least the way it's often defined, will be defined as the standard deviation of historical returns. That's the definition of volatility for most sort of public markets. So if you look at it historically, historical returns of stocks and bonds. So this is the 1 year rolling volatility or rolling standard deviation of the 10-year Treasury, which is in orange, and
We're still looking at
S&P
your,
500.
sorry, we're still looking at your reading list. Are you showing us a new chart?
Yeah, do you see the chart?
Yeah.
Let's see your reading list still.
Oh, sorry. Let me switch. Thank you for telling me. I could have continued all on my own. Can you see it now?
Nope.
There you go.
Oh, no.
Okay, cool. So if you see the 10-year Treasury, that's the returns, the 1 year standard deviation, backward looking, of the 10-year Treasury in orange, and then in blue is the 1 year looking backward standard deviation of the S&P 500 returns. So if you use Excel, that's the STDEV function on the returns. So what you see, there's 2 things you can take away from this. One, returns are all over the place. If you look at it, it's not like there's a return that's sort of there's not like a standard return that in sequence they don't follow each other. So using yesterday's return for tomorrow's return is going to be difficult. And then the other thing you can notice is that if you look at returns, bonds, which is normal, dip a lot less below 0 than equities do. See, these blue pieces are basically returns dipping below 0. And this, sorry, I said something. This is not the volatility graph. This is, sorry, the returns graph. I'll come to the volatility graph. This is the returns, the 1 year return graph. Sorry, I misspoke earlier. So the returns here is in equities dips below 0 a lot, and the returns on bonds don't dip as much below 0. So what if you're looking at this, what you're saying, well, is if I'm less likely to dip below 0 on bonds, why don't I try to get more out of bonds than out of equities? And the way to do that is partly allocating more risk to bonds. In order to do that, you have to leverage up, and I'll come to that later.
Could you qualify, sorry, Daniel, but could you qualify, so far when you've talked about, used the word bonds, are you talking about risk-free, or are you talking about credit?
So Nate, so here it's the orange one is the 10-year Treasury bond, and the blue line is the S&P 500.
Oh, 10-year Treasury. Okay, so this is risk-free.
This is really taking it the most simply, just using 2 asset classes, the risk-free rate for 10 years, and then the S&P 500.
Okay, wow, that's more volatility than.
Yeah, it's quite volatile, and you see you can have spikes up to sort of like 50-ish plus % on equities. Whereas bonds, you've had some volatility. This is when the Volcker starts stepping in, but other than the Volcker time where they stepped in, it really doesn't go above 20%. So another way of looking at it is what people call the autocorrelation function, and that's just a fancy thing of saying if I try to run correlation by moving the 2 assets lagging one by a year. So I take basically the returns of the past 2 years, and I try to correlate it with the returns from the past 1 to 3 years. So I just sort of shift the bucket of returns, and that's what people call autocorrelation. And so it's a way of trying to measure if you can predict with historical returns future returns. Essentially, what it shows is that there is really there's no what they call it's not stable. So it's very hard to predict future returns with past returns. That's the takeaway from this graph. Now this is the graph of volatility, which I misspoke earlier. Here unfortunately I switched the colors around, so sorry for that. But this time in orange, it's the S&P 500, and in blue, it's the 10-year Treasury, and it's basically the standard deviation of the past year's returns. this blue line here, you're probably wondering why it's so low. That's just because before 1955, we don't have monthly data. So you can disregard any bond volatility, so the 10-year treasury volatility before 1955, just because the data is not the same frequency as the data beyond that. But the takeaway here, and by the way, these are on two separate graphs, two separate sort of scales. On the left, the S&P 500 volatility is on the left side, so it's here, and the 10-year treasury, the blue line, is on the right side. So it's not at all the same level. See, the maximum is, call it 17% on the 10-year treasury, and the maximum on the S&P 500 is, call it 65%. So they're completely different scales. Just bear that in mind. But the idea behind that is to sort of use this sort of analogy is putting them on the same scale. So in order to get sort of the same risk, you have to bump up the risk of the bonds to get about this to get to a risk level that's equivalent to the equities. Because otherwise, if I were to put this on the same scale, what happened there? I clicked the one. If I were to put them on the same scale, that's what bonds would look like relative to equities. So completely, very, very small. So this is basically the reason why when you put a 60-40, you're getting so much of your risk that's coming from your equities and very little of your risk that's coming from your bonds. The other thing you can notice is that this tends to be somewhat more stable than returns. So volatility, if you look at equities, they're sort of around the, call it 15%-ish, and fairly, they deviate around it, but it's roughly around 15%. And bonds are, call it, around the 5% level. They deviate from that, but they're fairly consistent around that. So what we're saying is that it's easier to predict volatility with historical volatility than it is to predict returns with historical returns. And that's part of the premise. And I'll come to it slightly later. The other reason that you have two asset classes, like we mentioned, a 60-40 or even risk parity, is that you want to get asset classes that are decorrelated from each other, that don't have a positive correlation or have the least amount of correlation possible. And so this basically just shows you the 2-year backward-looking correlation. And what you're trying to go for is something that's not 100% correlated. And anything that is negative correlated is even better. But as long as they're not 100%, you gain from, there's a positive effect from diversification. But in order for this to be useful, you need the risk to be the equivalent on one side as it is on the other. So you need the risk of the S&P 500 to be equivalent to the risk of the 10-year treasury. So this is again a little bit more conceptual, but it's sort of what I was mentioning previously. The 60-40 is predicated on sort of a CAPM framework, and that's what you see on this graph here. A CAPM is essentially capital asset pricing model, and what we're saying is that you want a mix of assets that enables you to hit this line, and this line can be replicated with a number of assets in your portfolio, the risk-free rate, and then with a bunch of other risky type of assets, you can get to this line. That's what they consider the optimal portfolio line for any portfolio. And right now, with only 2 assets, we've got this risk-free rate and call it that equity rate there, right? And the assumption in the CAPM is that you know the expected return that's up here, and you can predict that fairly well going forward. And then you can predict also the standard deviation. The slight difference in the risk allocation type of model is that you're not expected to figure out what the expected returns are. You're just expected to figure out what the standard deviation is. So it relies on one less assumption relative to the typical 60-40 portfolio. And I'll stop there because that's quite an important concept, and there's been a lot that we've gone through. So if you have any questions, please speak up
now. I'm just going to go and watch this recording again because I think I need to pause it and rewind it and think about some of these things for it to really sink in. This is a little over my head.
Okay, so I'll just repeat it. The 60-40 is predicated on knowing what your expected return is and knowing what your expected volatility is. The risk allocation type of portfolio is only predicated on knowing the level of volatility that you have. It's only predicated on forecasting the volatility level going forward. And if I were to take out this black line, because right now all we have in our portfolio is called the 10-year treasury and the S&P 500. So the 10-year treasury would be here, and the S&P 500 would be that black dot. And you can figure out any level of risk you want on this line by a combination of those things. But in order to get there, when you're far away from the black line, you need to consider leverage. So I'll go back at it again. Returns are not stable. So the CAPM model is a little bit difficult because it implies that you need to know what your future returns are, and that's very difficult to predict. The optimal portfolio, therefore, assumes a perfect knowledge of future volatility and future returns. That's what the 60-40 portfolio is predicated on. As we've seen, volatility is more stable, therefore more predictable than returns are. Volatility is more predictable, more constant than returns. Volatility is a measure of risk, so that's why we call it sort of the risk parity or risk allocation model. It's easier to manage your risk, which is the takeaway, than it is to manage what your return expectations are. So I'll show you in practice what that looks like. So the next graph here, we're going to go through a few graphs, and then I'll bring it all together at the end. So don't worry if you don't understand one single one, because at the end I'll go over the totality. So here what I've done is I've plotted two things. One, just the typical S&P 500 in red, so without any modifications, the total return on the S&P 500. And then I plotted the S&P 500 that has a constant volatility of 12%. So essentially you lever up or down if the volatility exceeds it. So if you look at this graph, the yellow line, the volatility goes up or down. So when the volatility is higher, you have less exposure to the S&P 500, and when the volatility goes lower, you get more more exposure to the S&P 500. That's what that gray line is. So one of the takeaways is that this gray line that has constant volatility roughly ends up in the same spot as where the S&P 500 does. But if you look at it, the dips are lower. So the drawdowns here, for example, are lower. And that's normal because when volatility starts popping up during these recessions, your volatility sort of goes up, and therefore your exposure, because you're allocating risk, goes down. And these are basically what the metrics look like. So the return is basically the same. The volatility is basically the same between the two. So the risk S&P 500 is if you maintain the volatility always constant at 12% every month. And then the native S&P 500 is essentially the S&P 500 if you just let it fly. And this is so this 12% is normal. It's the same because this 12% is average, but it varies a lot. This 12% is basically more or less constant every month. And the Sharpe ratio is roughly the same. But the benefit is that your drawdowns are slightly smaller here. Now, if I do the same thing and I look at it on the 10-year Treasury, so I look at the same thing on the 10-year Treasury. Now, the interesting piece on the 10-year Treasury, so roughly the volatility on the 10-year Treasury is about 6.4%, and you get a return of about 6.1%, and a Sharpe ratio of 0.96. And so the red line is basically that volatility of 6.4 with a return of 6.1. So it's basically like the 10-year Treasury total return. It starts in 1955 again because before that the data is not very good. So we get essentially again to the same place, slightly better, but it's essentially the same. And the gray line is basically the same bond, but you keep the volatility constant every month at 6.4%, as opposed to letting it bump around that 6.4%. And again, what you get is something that increases much more assuredly and slowly. Now, if you combine those two things and you look at what the difference it causes. So in one case, here you have the 60-40 portfolio versus the 40-60 portfolio, as I would call it. So the 60-40 portfolio is if you basically say 60% of your dollars in stocks and 40% of your dollars in bonds, versus if you put 40% of your risk in stocks and 60% of your risk in bonds. So this 60-40 would be something like 90% of your risk in equities and 10% of your risk in bonds. So it's much more skewed to the bond. That's the idea behind it. And the slight subtlety is that I've targeted this portfolio to be the same amount of risk as this portfolio. So this 40-60 portfolio of risk has a 12% volatility. Sorry, my bad, it's here. 7.9% volatility, which is the average volatility that you have for the 60-40 portfolio over the course of the 1955 until today. So they're basically the same volatility of portfolio, except the 60/40 will bounce around more because this basically is 7.9% every month because you rebalance. And so the takeaway that you get is you actually get, for the same level of average volatility over the whole period, is you get about 200 basis points of outperformance relative to the 60/40 portfolio. Okay, so you get basically 200 basis points better by allocating risk on a more equivalent basis than you do on 60/40. Now, there's a slight subtlety that a lot of people will tell you, is that we've been in a bond bull market since 1980, roughly, right? Because Volcker started hiking rates and he brought down interest rates. But if you still look at the period pre-1980, from 1955 to, call it 1980, that portfolio, the risk portfolio in black, 40/60 risk, still outperformed the 60/40. And the drawdowns were a lot smaller. So that's the concept behind it. And I'll pause there for a second because there's probably a lot of questions around that. Anybody? Barry, I see you frowning. You're muted, Barry, I think.
No.
Oh, there you go.
No, I'm not. I'm just trying to absorb this because I was coming to a conclusion that then instead of having a portfolio full of stocks and bond mutual funds, you might as well just choose a ETF or a mutual fund that's tracking the S&P 500 and buy some 10-year treasuries and ride it out.
Yeah. So there's first of all, this is sort of good because it's sort of hindsight, because the 40/60 is roughly the good allocation, probably one of the best allocations you could have had over that time period. So bearing that in mind, risk parity would be 50/50 risk, right? Not 40/60 risk. But I did it as a symmetry to the 60/40 versus 40/60. So actually
Right.
putting more risk in bonds, at least historically, would have been more beneficial than putting more risk in equities. And I just wanted to highlight that even though equities have a higher sort of a higher return over the long term, their risk-adjusted return is lower than bonds historically.
But could that be? Yeah, that's historically. But
Right.
what about current conditions?
So current conditions matter a lot, and that's why we've talked about that 1940 to 1950 period, because in sometimes there can be sort of slight subtleties. The problem is we don't have very good data before that, but even if you consider the 1940 to 1950 period, yields didn't move basically, right? So even if you had a lot of risk in bonds, you wouldn't have got hammered by those bonds. Equities would have done better, but you wouldn't have lost a lot of money because the bonds didn't really appreciate that much. They sort of stayed stable for that whole time.
Right.
And then here, we're actually in a rising interest rate environment, right? From 1955 to call it 1980, even though we're in a rising interest rate environment, that portfolio still performs better.
Daniel?
Yes.
So I'm looking at this, and it kind of it seems to me that because your starting point was the 1950s, that we're looking at two different portfolios that would belong to your grandparents, you know, the great generation, right? Mm-hmm. Who were in their prime during those years. And I wonder if, because that's the historical starting point, whether that prejudices this chart to come out in a way that might be misleading for us in our decades of very low interest rate return on risk-free bonds. And it reminds me of the talk that I think his name was Neil Isaacson, gave. I might have been looking at an Orange County webinar. Don't know if you guys saw that one, but he was Craig Israelson, and that was an Orange County webinar. And he was talking. He showed a spreadsheet where he said that portfolios are immense. I thought this was a great point too. He said that portfolios are immensely influenced by the starting point of whichever generation you're talking about. And he particularly was talking about when people, at the point at which people would start to draw down from their retirement accounts, and how that would negatively impact.
Right, but this doesn't assume any of that. This is just market return. This is not assuming that you're putting in money or removing money. It's just considering that you're using the same either risk allocation or money allocation over the, I don't call it, 70-year period.
There's historical data, though, that does influence the outcome. And so the point I'm making is, you look at my grandfather's portfolio, he made a ton of money during the Volcker years when interest rates went through the roof. And
well, that's this period here. Both portfolios make quite a bit.
Right, but it's at one point they were in parity up until, and if you look far to the left, up until 1963, and then something happened that made the black line ascend further. And from that point on, you have the factor of compounding interest working in its favor.
Yeah, but if you still bring down, even, okay, so bring this down, this line, this gray line back down to here. You still basically beat it over that time period. This still is better than this chop here, up until maybe that point. And then even if you bring them back down, overall, this has fewer drawdowns, and it basically still beats the other one. Even bring these two down, you still beat the market over the past 30 years.
Well, I'm sorry, but what this chart says to me is that if you were lucky enough to be born into that generation, when you could actually retire and just have all your money in a savings account and make a ton of interest off of it.
No, it doesn't say that at all, because you would have had to lever up your bond account in that sense. This is completely separate from that sort of discussion. Okay. There will be periods in history where both portfolio perform better than other periods in history. I don't deny that at all. That's just the nature of investing, right? You've got boom periods and you've got bust periods, or not as good periods. I'm just trying to compare two alternatives. One that essentially, which one is better for you? So the slight caveat, and I'll come to it slightly later, is that the 60-40 portfolio is more hands-off than the 40-60, and that's why a lot of people go to the 60-40 versus the 40-60. And I'll run you through why that is.
Okay, please proceed. I'm sorry.
Okay. So one of the concepts we said is the reason it's good to do that is because the assets are not correlated or lowly correlated. Now, another asset that's not very correlated is gold. So gold, basically, if you would add gold to the portfolio, it gets even better. So the red line here, sorry, the gray line is the S&P 500 plus the 10-year plus gold. So it adds a little bit. It doesn't add a lot. And for some reason, my data stops here in 2016. I don't know why. Versus what the equivalent 40-60 in red is. So the original black line that you saw here is the same as the red line you see here. And then the gray line is if you add gold to it. And the yellow line is basically what gold would be if you had constant volatility on it. So gold does improve your overall returns, and it also minimizes to a certain extent your drawdowns. So that's the benefit of it. And so if you look at the metrics here, because the reason it starts in 1970 is because gold wasn't freely traded before that. So here, if you look at your metrics, you have essentially a 7.8% volatility for both portfolios, the portfolio with and without gold. You've got roughly an 8.5% return on both, but you have a slightly better chart because when you do this ratio, the risk reward with the gold in it is slightly better. This is with monthly rebalancing, as I'm putting it here. So that assumes that you rebalance your portfolio every month so that your risk is the same. Now, if you were to rebalance more often, and the split here of risk is 40% in S&P 500, 50% on the 10-year Treasury, and 10% on gold, it gets better. So starting sort of in the same, and now the reason that starts in 1976, roughly, or end of 1975, is because we only had monthly prices for gold in 1970. In order to rebalance weekly, we have to wait till 1975 to get better data. So now the red line, so now this gray line is equivalent to the red line here, but this red line, you're rebalancing weekly instead of rebalancing monthly like you were on the previous graph. And so now let's look at what those metrics are. So you're basically maintaining your portfolio volatility around 10.5%. You're getting returns of 13.3% over the long term, and that gives you a Sharpe ratio of 128 versus the Sharpe ratio of 112 when you're only rebalancing monthly. So part of the reason a lot of people don't choose to do risk allocation is because it's a lot more involved. You have to be, to really benefit from it, you have to be really rebalancing weekly. That's also why I tend to say that gold, you don't want to put too much of it because gold is a low yielding asset. And in order to get its benefits, you need to be rebalancing often in your portfolio. So just recapping a lot of what we said, the strategy here requires the use of leverage. You need to lever up gold, well, not necessarily gold, but you mostly need to lever up bonds and potentially lever down equities, but you need to use leverage. The cheapest form of leverage that you have is essentially futures. Because if you use other stuff like ETFs that have leverage characteristics, they will be more expensive, generally speaking. So the second thing is to use cheap leverage and futures. There was an innovation recently. I don't know if you call it innovation, but there was a slight difference. Is that previously one contract on the S&P 500 was roughly $150,000 of exposure. More recently, they divide by 10, so now you can get $15,000 of exposure by a mini version of the S&P 500, so a smaller one, which makes it much more feasible to use the strategy than it was, I think, 3 years ago. I think the innovation, that change at the CME happened a year or a year and a half ago. There's also tax implications, which I have not represented here. If you're using futures, they have different tax implications than an ETF or an outright stock would have. And it's not necessarily a bad thing because futures don't have that split between long-term and long-term taxes versus short-term gains. They have a split of 60-40. 60% of their gains are considered short-term gains, and 40% of their gains are considered long-term gains. So they have a constant sort of tax implication for it, as opposed to a stock that if you hold it over a year, you get long-term capital gains, and if you hold it less than 1 year, you get short-term capital gains. So they're also, it's a useful way of basically using something that you're going to, if you're rebalancing often, the futures can give you a benefit because you're probably going to be selling some of these for less than 1 year. So you won't get necessarily just a short-term, you'll get a better tax rate than you would if you had just sold the stock. So essentially, if you're trading something for less than a year, a future is a better way to get that exposure, purely from a tax perspective, than a ETF or equity is. Again, then you have other considerations of liquidity and what exact exposure you want. Futures on individual names aren't very liquid. Futures on indices like the S&P 500 are extremely liquid. You can expand this logic to any other market. What you're looking for is markets that are not correlated with each other. That's why I chose equities, then bonds or treasuries, and then gold. You could imagine putting maybe agricultural exposure or any other type of asset class that is not correlated to your other asset classes. That will benefit from the risk allocation. The higher the long-term returns are on that, the more benefit you will gain, of course. And the lower correlation will also benefit to your portfolio. But that's the same thing for like a 60-40. It is helpful to think of decorrelated markets as buckets of risk for allocation. So that's what I was saying. Equities is sort of a bucket. Treasuries, or the risk-free rate, is sort of another bucket. And then commodities. So equities, you can have U.S. or foreign equities. Treasuries, I would consider like the U.S. Treasuries to be a risk-free bucket. Boons, the German boons, are probably the other risk-free bucket you can think about. JGBs are a risk-free rate, more or less. You can think of those in buckets. And then commodities are sort of another bucket that's uncorrelated or lowly correlated to the other two. So gold is one of them. Inflation-sensitive assets are other ones that are not as correlated to these two. And then uncorrelated assets in general. And one of the reasons commodities helps and why gold helps is because when you have high inflation, these two other things don't tend to do well. So equities and treasuries don't help to do well. So if you're thinking of different regimes of the economic cycle, there's the gold basically is uncorrelated because there's a high inflation regime where treasuries and equities together don't perform well. It's a much more active and strategy than would be your typical 60-40 portfolio, which are probably going to rebalance maybe monthly at most, maybe once a year oftentimes, but you're not going to touch it all as much. You would probably want to ideally rebalance your portfolio weekly if you're using a risk allocation type of strategy. And then just to hammer that notion into why gold, bonds, and equities are sort of their different characteristics, and why risk allocation makes sense, I used this. This is a graph of the Sharpe ratio of each of those assets. And the Sharpe ratio, all it is taking the returns of the past, I think it's past 3 years here, divided by the standard deviation of the past 3 years. So that's what you see on this graph. So in red, you basically have the Sharpe ratio of the combined portfolio with gold, bonds, and equities. The yellow is gold. The blue is the S&P 500. ES1 is basically the futures on the S&P 500. And then the gray is the 10-year treasury. So, and then here are the characteristics, and I'll come to it. So, and they sort of emphasize what I'm going to say. So if you look at gold Sharpe ratio, so you want the Sharpe ratio to be mostly in the positive territory and preferably the highest possible, right? You want it's the most bang for your buck. Sharpe ratio is a measure of the bang for your buck. And so gold often dips below zero, which is here. And you see that there's a lot of periods where you don't get as much bang for your buck as the other asset classes. That's why it's over the long term, it's not as beneficial. At the blue line, the equities, you often get a good bang for your buck, but you get periods where it drops below sort of zero, and it's not as good. That 60-40, the 10-year, the 10-year treasury, you get fewer dips where the Sharpe ratio goes negative. So the bang for your buck stays positive a lot more often. Recently, it's not been as good. So recently, gold's been good. Equities have not done as well because we've been chopping for the past sort of 2 years. Bonds didn't do very well, but are doing better because basically the Fed cut. The portfolio, the mix of the portfolio is still doing pretty well if you use a 40, 50, 10 type of portfolio, 40% equities, 50% risk in treasuries, and 10% risk in gold. And so you see that red line stays roughly above zero most of the time. It does have some dips below zero, but you basically get a better bang for your buck over a longer period of time. And this is basically a summary of that logic. So if I were to take the average Sharpe ratio, so the average of these curves, they're right here. So on average, your Sharpe ratio for that portfolio since 1978 is about 1. So you get 1% return for 1% volatility, and you get lower for all the other asset classes. So equities, you get 0.7. Bonds, you get about 0.55, and gold, you get about 0.29. And then what you look is what the standard deviation. So how much does that move around the actual average? And so you see that gold moves, even though it has one of the lower Sharpe ratios, it moves a lot around its average Sharpe ratio. So its average bang for its buck is very volatile. Bonds have the average bang for the buck is a lot less volatile, and equities is one of the most volatile bang for your bucks. But on average, if you were to combine those, you still get a pretty good bang for your. It doesn't deviate too much over the long term, and the average also matters because essentially what you're saying is you want your average bang for your buck to be above zero. So I'll stop there. I'll leave it open for any questions, and I know we're on time, so if you guys need to leave, I won't feel bad if you just jump off. But if you have questions, please go ahead.
Is this so? This is something that you've back tested really well. Is this a model that investment advisors have been using prevalently?
So this is
because of the how work intensive it would be to be rebalancing all your clients' portfolios every week?
So I'll give you a little bit of background. Bridgewater is, I think, the best known hedge fund that has used this policy for this sort of type of risk return over a long period of time. Bridgewater is Ray Dalio's company, so they've been using this type of framework for a while. They call risk parity, and it's slightly a misnomer, and they think of it in sort of 4 quadrants, 4 types of economic cycles. The economic cycles, they divide them in 4 quadrants: increasing growth, and decreasing growth with increasing inflation or decreasing inflation. So that gives you 4 scenarios. And each of those 4 scenarios, they say you should allocate 25% of your risk. And that's what they call the all-weather portfolio. And in those scenarios, they look at what asset classes for each one of those 4 buckets perform the best. And so that's why they say, and in a high growth, high inflation environment, it's going to be commodities, for example. In a low inflation, high growth environment, equities are going to do the best. In a deflationary, low growth environment, bonds tend to do the best. So that's sort of the way that the framework comes to be. Now, this is slowly permeating into institutional type of investors, but people are still averse to it because of the use of leverage. And the main problem that this strategy encounters when it's trying to be implemented by anyone is the use of leverage, because a lot of people shy away from the use of leverage, and sort of, and that also implies how often you have to rebalance it. I don't think there's financial advisors that do this, just because I don't think it's something that a lot of clients will be asking, generally speaking.
I heard Ray Dalio was interviewed on Bloomberg, and I heard him challenged because I believe it was his alpha fund that had underperformed so badly, and we had investors bailing. And he was quick to point out that the other portfolio, which you named, I forget what that is called, which is what this is.
All weather.
Yes, he said his all weather was doing quite well. Yeah,
because the concept behind it is to not make any bets on the economic cycle, just like the 60-40, and to target an amount of risk that works in most environments. That has an equal amount of risk for all the different types of environments you can find. So if you wanted to be more active, what you could do, for example, is you say, I think I can sort of, I have a bias on which environment we're in and on which asset classes I think are going to outperform. So instead of allocating risk on a 40, 50, 10 basis, I'm going to say, oh, well, I want to allocate 60% risk in equities, 30% risk in bonds, and 10% in gold, for example. The framework is flexible in that sense. And the other thing, because you're using leverage, you can dial up or down risk over the cycle if you wanted to. So you could, for example, say, well, I think we're close to a recessionary environment. It's a risky period because the 10-2 year is inverting. So I don't want to run my portfolio at 12% risk, which is sort of the average equity volatility. I want to run my portfolio at 5% risk right now. And I'm going to keep that for the next year or so. I think I want to run it at 5% risk.
Okay.
But again, this is a lot more involved. I don't think it's probably a little bit too complicated for most retail investors, just because it requires a high touch. It's probably easier if you're retired than if you're not retired, because you do need to religiously rebalance, I'd say, every Friday if you think about it.
Daniel, how much leverage is involved?
That depends on how much risk you're taking. You could dial down your whole. So your bonds, you're almost always going to have to lever, right? Because bonds, we said, are about 5% risk. So the only logic is if you wanted to run the portfolio about 5% risk, you probably wouldn't have to lever bonds too much, right? Because you would be running at that risk. What you would have to do on the flip side is you have to dial down your equity exposure. But if you're going to want to run it at a 60-40 portfolio level risk, which is about 8% since 1955, that basically means that if equities are sort of around 12%, you're going to have to dial down the equity risk and dial up the bond risk from 5% to 8%. And then you're going to have to dial down the equity risk from 12% to 8%.
This sounds like something that would be perfect for algorithmic systems to try and deal with.
Well, I mean, algorithms are good, but you don't really need. I mean, the reason you would use an algorithm is because you want to execute quickly. You don't really need to execute quickly on this because you're rebalancing weekly.
It seems like there's a lot of math going on all the
There's
time.
math, yeah. So you can do an Excel spreadsheet and then just say the Excel spreadsheet tells me to sell this number amount of contracts and buy this other amount of contracts, and just rebalance like this. But you don't. Algorithms is often if you need quick execution, is the way I think about it, because you want to interface it with the with your execution broker. This doesn't really need that because it is still only weekly rebalancing that you're getting benefit of.
Okay.
If you want to get more and more involved and maybe go to sort of like daily or I haven't tested intraday rebalancing, but daily rebalancing does slightly better. Weekly rebalancing doesn't. There's not that big of difference between weekly and daily, and I haven't tried intraday type of rebalancing on this sort of thing.
Wouldn't you reach a point if you were to really intensify it that way, where your trading costs would be too excessive?
Well, exactly. That's why I think weekly seems reasonable. And bear in mind that futures are a cheaper way to get exposure than, well, maybe not now that Schwab has gone to zero, but generally futures, to get like $150,000 of exposure, it'll cost you maybe like $2 to transact. So futures are a very cheap way to get exposure.
Right. Are you including the margin from using futures in the 100% calculation, or are you just using the cash that's in the account to account for what 100% means?
So your the amount of cash that you need to manage your margin requirements is never a problem, because you usually, I think the most, even if you dial it up to like 15% volatility, which is where you need the most margin because that's where you have the most exposure, I think you still only use 25% generally of your capital.
No, my question is, in calculating what 100% means in the context of your portfolio, is it its total market value plus whatever cash you have, or is it that plus the magnification of what you own? In other words, you're saying you're using a certain amount of capital to control $150,000 worth of futures. Yeah. Is that $150,000 figure added into your other cash equivalent holdings to make the 100%?
It's two separate buckets. Think of, you need roughly, it'll vary, but think about you need roughly 10% of your notional exposure. So you need 10% of $150,000 in your margin account to control a future. Okay. That leverage 10 to 1 is so big that you generally never have a problem with your cash.
I'm only counting the 10% that's using the futures in the calculation of 100% of what my portfolio consists of.
Yes.
Okay. That clears up that confusion. Thank you.
But you'd still get these type of returns, but you don't. Essentially you're going to have probably some part of your cash that you'll probably want to put in sort of like a money market type of fund or like a 3-month treasury, because you'll have residual cash that will be left.
Okay.
Does that make sense?
Sure.
So let's say to get and the other way of doing it is you calculate what amount you need to put into futures. So the best way of probably doing it is that, let's say you want to first get your exposure through the ETF. So you first look at how much you can put in the ETF, and then you backfill to how many futures you need to get your leverage. Right? Because arguably you could just use ETFs to get the exposure, and then the residual leverage you calculate how much cash you need to get the residual exposure through futures. But you can do a combination of ETFs and futures. The reason you're using futures is just to get the cheap leverage.
Okay.
I don't know if that makes sense. That was a little convoluted the way I said it. And it's hard to explain without sort of going to the numbers, which I don't have ready here.
I understand what you're saying, but
Okay.
Let's ask other people how they're doing.
Okay. Barry, anybody, thoughts, questions, comments?
Yeah, I've not ventured into futures yet. The options puts and calls seem to be working for me as a way of offsetting the low interest rates right now.
Okay. So the futures usually have a bad rep, but I think that's just a reputation, because often what people do is, because you only need 10% of the cash, they take too much risk. But if you had a future where you put in, let's say you had $15,000 and you put $1,500 in your margin account, and they kept the rest of that in cash, it would be very equivalent to an ETF. So the reason they get a bad rep is because what people do is that they have $15,000. So instead of buying one future contract, they buy 10 future contracts. And so they have 10 times the amount of risk than they would have with an ETF.
Right.
So the reason they have bad rep is because people take too much risk when they use futures, generally speaking. But you don't have to do that. That's just because people tend to be risk seeking. They oftentimes they feel like they're gambling when they're using futures.
Right. People think I'm gambling doing options.
Well, options also have leverage, so it just depends if you manage your risk or not.
I'm very conservative.
And I'll do options the next time, unless people. Is everyone interested by options, or at least having a quick course on how options work?
I'm keen to learn anything and everything you've got.
Okay.
So other people need to answer this question and be more vocal so that you get more guidance from, everybody.
So I referenced a few articles. Bridgewater is not exclusive in their logic of sort of volatility targeting or risk targeting, but there's 2 papers from Bridgewater here in the reading list. There's some from BNP, but essentially it gives you different views of how this works. I'm happy to answer any questions if you guys want to later on. This will be posted. I'll post it to the website. But this is sort of a brief overview of how it works. It's once you have the data, it's fairly easy to run this yourself with an Excel spreadsheet. It does get a little slightly involved, and it's time intensive. So just bear that in mind. But I think at some point retail investors will get there, but there needs to be a product, sort of an easy product to do this, to manage it. The big difference is that people will defer on what amount of risk they want, and this type of framework can accommodate any type of risks. So you can run this at 5% volatility up to like whatever type of volatility you want, 15%. What I came out at is 10% seemed to, when I ran this at 10% volatility, which is slightly lower than what equities are and slightly higher than what a 60-40 portfolio is, it got you to about maximum 20% drawdowns historically. And that's sort of what I felt comfortable with, is sort of running it at a 10% volatility level. Anywho, so I'll post this. I'll also post the market update on the website. There are a few additional graphs for those who are interested that we didn't have time to go over on the market update. But that's it for today. I hope that was interesting. And so next time I'll plan, again, a slight market update with a quick, well, not a quick, but a session on options as requested by most people.
Terrific. Thank you so much.
Thank you, guys.
Yes,
Have a great
thank
evening.
you, Daniel.
Take care.
Thank you, Daniel. Thank you.